The technocrats have gathered together at Davos to make their voices heard. From politicians to bankers, this is the World Economic Forum, and political agendas are out in full force. Unexpectedly, there have been an unusually large amount of predictions of economic doom. Why this sudden change of heart? You came here for the truth, so let me unveil that for you. Today, we are going to cover what's happening at Davos. This year, in 2018, it seems that there is a change in the overall sentiment. Let's cover it today. I want to begin with this. Billionaire hedge fund manager Ray Dalio said that the bond market has slipped into a bear phase and warned that a rise in yields could spark the biggest crisis for fixed income investors in almost 40 years. This is his quote. A 1% rise in bond yields will produce the largest bear market in bonds that we have seen since 1980 to 1981. We're in a bear market. These are some bold words. He also comments here talking about the Federal Reserve, talking about interest rates, but I want to cover what's happening at Davos, go through all of the different talks that have been going on that mirror exactly what I have been saying. So let's get right into it right away because there's a lot to cover and I just want to touch on each point, okay? Remember that as I cover this, think about all of the things that I've been talking about, that I've been criticized about, and how these individuals, the biggest of the big, globally, are talking about it now. Global finance executives warned of parallels between today's soaring stocks and the froth of the pre-crisis years, as they said investors could be wrong-footed by central banks raising interest rates. All right, I want you to take note the fact that we are seeing indicators that do not make sense. We are seeing interest rates being the linchpin, being that catalyst. Look at what they said. As the World Economic Forum's annual meeting got underway in Davos, the leaders of Barclays, Citigroup, Carlyle all fretted that the strongest global economy since 2011 was leaving financial markets complacent. Equities worldwide are already up more than $3 trillion this year. Everybody, it's 2018. We're still in January and the market's up $3 trillion. That's insanity. It's going parabolic. Okay. There is a numbness out there. There is an ambivalence out there that's concerning. This is the Citigroup CEO saying this, okay? They have derivatives. They have all kinds of, ridiculous products that they create. And he's saying it's getting a little crazy out there. All right. When the next turn comes, and it will come, it's likely to be more violent than it would otherwise be if we let some pressure off along the way. This is exactly what I have said, just talked about it recently. How if the market would retrace its steps, maybe come down by 10%, maybe even 20%, find a firm footing, and then go higher than it was before, we would find that natural. We would think that is a very beneficial thing. Let off some steam. It's good to do that. But instead, month after month after month, the stock market breaks new ground. That's not a good sign. Yes, there are days when it does bad, but overall, month after month, it's hitting new highs. How is that possibly sustainable, and how is that manageable on any level? We are seeing the indicators piling up left, right, and center. The CEO of Barclays said the upbeat environment reminded him of the eve of the last crisis a decade ago, and that the combination of stocks at record highs and volatility near all-time lows wasn't sustainable in the long run. He too said the trouble if central banks such as the Fed push up borrowing costs faster than investors anticipate. I talked about this 1,000 times. The stocks are going too high, volatility is too low, the VIX index, right? And we are seeing this doesn't make sense, especially with the Federal Reserve starting to increase interest rates. It's very frightening for all those involved. Okay, so they said that the financial services companies had learned from the last crisis and were now more resilient and less complex. Of course, that isn't true, and we know that as a fact. All right. I do feel it's a little bit like 2006 when we were all talking whether we've solved the riddle of economic crises. We've got a monetary policy that's still in the remnants of the Depression era. We've got very little capacity in the capital markets to deal with a real move in interest rates. Look at where they are today. Where would they go if another recession hits? Of course, into the negative, and the QE4 would have to take off. With interest rates around the globe close to record lows, here they are saying it for themselves, companies have binged on cheap borrowing. U.S. corporations have a record amount of debt and leverage, with many as vulnerable to default as before the crisis. Yes, of course. The explosion of leverage loans, which banks structure for already indebted corporations and then sell onto investors, underscores this trend. Citigroup and Barclays are among the banks to have profited from the boom. The firms arranged a combined $168 billion of U.S. leveraged loans in 2017. Okay, this is exactly what I covered at the beginning, talking to you about the fact that these are the ones that are involved in all this criminality, and yet they're saying, I see a little problem here. Oh, do you? Wow. All right. If interest rates go up meaningfully over the next 12 months, there will be a bunch of people who have borrowed money who will not be able to pay it back. Those people are out there and the markets are not in aggregate pricing that. How many times have you heard me talking about that? Right. But then whenever I mention that specific point, I get criticized royally. Whatever. It's them saying it now. Now we have the quotes. Now we can see that they are saying that at Davos, publicly out there, saying exactly what I have been warning about, and for the same reasons. All right. Now, if interest rates go up even modestly, halfway to their normal level, you will see a collapse in the stock market. I don't know how everything from art and Bitcoin to stocks prices, everything will react if interest rates go up. Oh, I got a good idea. I've got a very good idea. Halfway to their normal level. Normal, I think, based on, their calculations here, would be around 5, maybe 6%. And that's pushing it. If the U.S. interest rates, the Fed funds rate is at, let's say, 1.5, we would have a big problem if just 1% more higher is going to do the trick. It's going to be a very, very big problem. And of course, interest rates aren't just on what you think. I mean, we also have to talk about the ripple effect. Higher rates will also affect the $5 trillion burden of dollar-denominated debt held by emerging market companies, the panelists said. Among other risks, they cited mounting government debt in China and elsewhere, rising protectionism, and the potential for geopolitical shocks. The biggest concern I have is that most people think that there is no problem of a likely recession this year or early next. Generally, when people are happy and confident, something wrong happens. And while there may be no problem, what we have to worry about is a domino effect. One very, very small problem could all of a sudden cause a very, very big issue. Look at what happened during the financial crisis, right? You had all sorts of companies that were bankrupt. You had so many people losing their jobs. You had the situation where we had nationalized companies, countries were selling off assets. I mean, it's still going on today, but where did that all start when you think about it? Subprime mortgages in the US, derivative products. And the trickle effect was felt globally. Real estate prices were devastated in many, many markets around the world. But it was a subprime, this is what we were told, it was a subprime mortgage crisis that was contained exclusively to subprime in the US. Nothing to worry about, nothing to see here. Please move along. Now, I've been told lies before. I don't really enjoy them, but here we are. Now, these are the concerns I have. The technocratic elite are coming out into the public forum, Davos, saying these things as well, for the same reasons I've talked about. For those of you out there, 95% of you, I know that you agree with me on this. It's those few out there who are heavily invested, and I'm very concerned because of that ripple effect that happens. You as an individual, you might know exactly when to sell, and you're going to sell at the very peak of the market, and you're going to be able to profit all the way to the bank. Now, that's good, but what about the individual that lives in your next door house, and the one across the street from you, and the one on the other side of you, and the one behind you, who have their pension funds, who have their mutual funds, their retirement accounts, their children's college fund, and everything else, all connected to the stock market, and it's going to get slaughtered? What's going to happen then? If they're all in big trouble, you're in trouble too. If you found this video informative, please give me a thumbs up. If you appreciate this channel, please give me a thumbs up. Comment below. I really do appreciate all the comments that I get. You know it if you've been here before. I try to comment to as many as I possibly can. I reply to all emails that are sent to me. It takes 2 weeks, maybe even more at times to get back to people, even up to a month to get back to people, but I do. I will get back to you. I try to do as much as I can because I really do appreciate everyone that's here supporting me, supporting the channel, and of course, wanting to learn more. So of course, that's a very good thing. Now, if you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have a look inside feature. It's going to allow you to flip through the pages of these books to see if you like them. Take care.